$2.3 billion gone in one trading day. This defense contractor had the worst session in its history, down 41% at the low. Most people watching this get the lesson backwards. What's up, guys? Coach B here. Welcome to the breakdown. Today it's Parsons, ticker PSN, a defense and critical infrastructure government contractor. And here's the thing about a guidance cut like this one. They are not all the same animal. Some cut revenue that's genuinely gone for good. This one didn't mostly, and the market nuked the stock anyway, the worst day it's ever had. That gap between what actually happened inside this cut and how brutally it got punished is the whole lesson today. Quick reminder up front, this is education, not financial advice. I'm not telling you to buy or sell Parsons or anything else. Do your own research. Parsons does defense work and critical infrastructure work for the government, roads, water systems, cyber, base support. Look at the run into this print. It closed June at 52.39, climbed basically the whole month, and closed the day before earnings at 62.03. This was a stock working. Then July 29th, it opened at $46.99, already a gap down of about 24%. From there, it kept falling all the way to a low of 36.26, about 41.5% off the prior close. It clawed back some into the close, finishing at $40.32, down 35% on about 12 million shares, roughly 13 times its normal volume. Parsons has never had a day like this. So what actually happened in the quarter? Revenue was about $1.6 billion, basically in line, but reported adjusted earnings swung to a loss of 6 cents a share against a 76-cent estimate, and GAAP earnings were worse, a loss of 14 cents. Almost all of it came from about $118 million in one-time divestiture and joint venture charges. Strip those out, normalized earnings were actually 86 cents a share. That headline loss isn't what crashed this stock. The guidance did. Full year revenue guidance got cut to 6.2 to 6.5 billion, well below the roughly 6.65 billion Wall Street was modeling. Adjusted EBITDA guidance got trimmed from 615 to 675 million down to 500 to 560 million, about 18% cut at the midpoint. Operating cash flow guidance came down too, from 470 to 530 million to 430 to 490 million. That is the guide. That is what actually cratered this stock. And management actually broke down where that revenue went. 85 million from divestitures, businesses they chose to sell. 125 million tied to critical infrastructure timing and lower pass-through costs. 90 million tied to federal solutions timing and funding delays. Add those up, that is $300 million, almost exactly the gap between what Wall Street expected in the middle of the new guide. Here's the actual lesson. Not every guidance cut is the same kind of bad news. Some cuts happen because revenue is just gone, a client walks, you lose a contract recompete, demand shrinks, and it is not coming back. Other cuts happen because the money is deferred, a divestiture you chose to make, a contract's timing sliding into next year, or pass-through revenue that barely carried margin in the first place. Parsons' cut reads a lot more like that second column. So why did it still fall the worst it ever has? Because a government contractor's whole pitch is predictability, and that predictability just broke. An 18% cut to this year's EBITDA is real money missing right now, whatever happens later. And it's just timing is an easy thing to say. The same morning you miss estimates, the market is not required to take management's word for it. Plus, funding delays on federal work can absolutely repeat next quarter. Deferred is not the same thing as safe. Now let's look at the actual chain. It shows how the market is pricing what comes next. Stocks at 40.32. The at the money 40 strike for August 21st, about 22 days out, is pricing implied volatility around 61% on the calls, 65 on the puts. Most stocks run 20 to 30%, so that's elevated. That straddle costs about $4.83, so the market's pricing roughly a 12% move either way into expiration. Call it 35.50 up to 45. Look at the skew too. The deeper out of the money puts get, the richer they are. 35 strike puts price near 64%. 30 strike puts near 76. That's the market paying up for downside insurance. And the 50 strike put is sitting on over 1,000 contracts of open interest, the highest of any put nearby, almost certainly written back when this traded near 60. Whoever sold those is underwater right now. One more thing to sit with. That new guide is still a range, 500 to 560 million on EBITDA. If those funding delays drag longer than expected or another piece of the business needs trimming, this lowered bar can still miss too. A cut guide is not a guaranteed floor. There's always risk in everything. So how would you think about this by time frame? Day trading it, you're trading pure volatility off that 36.26 low. Swinging it, the $40 zone is the level the options chain itself is treating as the center of gravity right now. And if you're an investor, the real question is not this quarter, it's whether that just timing story actually holds up or whether this guide gets cut again next quarter too. So that's Parsons, the worst single day in the company's history. And the print itself wasn't the villain. This was a guidance story, not an earnings story. And most of that cut is timing and divestitures, not demand that's dead and gone. Didn't matter. The market still punished it like the worst kind of news. Same reminder, this is education, not financial advice. I'm not telling you to buy or sell anything. Do your own research, subscribe, and I'll break down the next name on the board. Drop your questions in the comments. Good luck in the markets, no matter what stock you're into.